Stand on the observation deck of the Burj Khalifa at dusk and look out across Dubai's sprawling skyline, and you'll see something that should fill you with awe, but instead raises questions that nobody in the real estate industry wants to answer. Hundreds of office towers stretch in every direction, gleaming glass and steel monuments to ambition and capital. From this height, they look magnificent, a testament to Dubai's transformation, from desert outpost to global city in just a few decades. But look closer at the patterns of light as the sun sets and darkness falls. Notice how many buildings remain dark, floor after floor, with no light switching on as evening descends. Notice the towers where only the bottom few levels are illuminated, the rest sitting in complete darkness. Notice entire clusters of buildings in Business Bay, DIFC, Dubai Media City, even along the prestigious Sheikh Zayed Road corridor, where the ratio of dark windows to lit windows tells you everything you need to know about occupancy. Dubai has a crisis that's hiding in plain sight. The city has built more commercial office space than it can possibly fill, and the money that was supposed to keep flowing in from international investors, the capital that funded this construction boom and was meant to continue driving growth, has slowed to a trickle. Investment in Dubai's commercial real estate market has collapsed by an estimated 60% to 70% compared to peak levels in 2021 and early 2022. Foreign institutional investors, the pension funds, sovereign wealth funds, and real estate investment trusts that were supposed to view Dubai as a stable, high-return market have largely pulled back. Individual investors who bought office units as investment properties are underwater, unable to rent their spaces and bleeding cash on mortgage payments and service charges. Walk through the lobbies of office towers across Dubai on a Wednesday morning, what should be the middle of a busy work week, and the emptiness is palpable. Security guards sit at reception desks scrolling through their phones because hardly anyone is coming or going. Elevators programmed to serve 40 floors run mostly empty, stopping occasionally to pick up the handful of workers in buildings where occupancy might be 30% or 40%. Directory boards and lobbies list company names on perhaps 10 or 15 floors, leaving 25 or 30 floors conspicuously blank. The retail spaces on ground floors, the coffee shops and sandwich places that were supposed to serve thousands of office workers, sit empty or have closed permanently, their windows papered over or covered with available for lease banners that have been up for months. The numbers behind this crisis are staggering and getting worse. Dubai currently has approximately 55 million square feet of commercial office space across all grades and all districts. Vacancy rates across the city average 35% to 40%, meaning roughly 20 million square feet of office space is sitting empty. In some districts, the figures are even more dire. Business Bay's vacancy rate exceeds 45%. Areas like Jumeirah Lakes Towers and Dubai Silicon Oasis are seeing vacancies approaching 50%. Even in supposedly premium locations like parts of Sheikh Zayed Road, buildings are reporting occupancy below 60%. To understand how catastrophic these numbers are, consider that in a healthy commercial real estate market, vacancy rates typically run between 10% and 15%. Anything above 20% indicates oversupply. Above 30% suggests a fundamental market failure. Dubai is well past that threshold and still adding new supply. There are office towers under construction right now that will come online in 2025 and 2026, adding millions more square feet to a market that's already drowning in excess capacity. Investment transaction volumes tell an even bleaker story. In 2022, at the tail end of the post-pandemic recovery boom, commercial real estate investment in Dubai reached approximately $4.8 billion. In 2023, that number fell to $2.9 billion. In 2024, it dropped further to an estimated $1.8 billion. The first quarter of 2025 saw transaction volumes so low that analysts are projecting full-year investment could fall below $1.5 billion, a 70% decline from the peak just 3 years ago. These aren't small investors or speculators pulling back. These are major international institutional players who had committed capital to Dubai and are now exiting or refusing to deploy new funds. Pension funds from Europe and North America that purchase stakes in office towers or entire buildings are either selling at losses or writing down the value of their holdings. Sovereign wealth funds from Asia that were actively buying Dubai real estate have redirected their capital to other markets. Real estate investment trusts that raised funds specifically to invest in Gulf markets are focusing on Saudi Arabia, Qatar, and Abu Dhabi, deliberately avoiding Dubai's oversupplied office sector. The reasons for this investment collapse are layered and interconnected, but they all point to the same conclusion. The fundamentals that drove 2 decades of investment into Dubai's commercial real estate have broken down, and nobody knows if or when they'll recover. Let's start with the most immediate issue. Rental yields have collapsed to the point where office investments in Dubai generate returns so low they can't justify the risk. Investors buy commercial real estate for the income it generates through rent and for potential capital appreciation when they eventually sell. In Dubai, both components of that equation have deteriorated dramatically. Net rental yields on Dubai office properties are currently running at 4% to 6% for buildings with decent occupancy. For buildings struggling to fill space, which is most of them, yields are closer to 2% to 3%, or even negative once you account for vacancy periods, tenant improvement costs, broker commissions, and the ongoing expense of maintaining and operating the building. Compare those yields to what investors can get in other markets, and Dubai's investment case falls apart. Office properties in Singapore are yielding 5% to 6.5% in a stable, mature market with strong tenant demand. London office buildings in good locations deliver 5% to 7%. Even U.S. office properties, despite the sector's well-documented challenges, are yielding 6% to 8% in gateway cities. But it's not just about the yield itself. It's about the risk-adjusted return. Dubai's office market comes with substantial risks: tenant default risk, currency risk for foreign investors, regulatory and legal uncertainty, liquidity risk because selling commercial property in Dubai can take months or years, and the ever-present oversupply risk that rents will continue falling. When you're only getting a 4% to 5% yield, those risks aren't being adequately compensated. Investors can buy government bonds in developed markets and get 4% to 5% with virtually zero risk. Why tie up capital in an illiquid, risky Dubai office building for the same return? Capital appreciation, the other leg of the investment thesis, has also evaporated. Office property values in Dubai have fallen 20% to 30% from their 2021-2022 peaks, and in some cases, the declines are even steeper. An investor who bought an office floor in Business Bay in 2021 for AED 10 million would be lucky to sell it today for AED 6.5 million to 7 million, a loss of 30% to 35% before accounting for transaction costs. And that's assuming they can find a buyer, which is increasingly difficult. The financing environment has also turned hostile to commercial real estate investment. In 2020 and 2021, when interest rates globally were near zero, borrowing money to buy commercial property was cheap. Investors could finance 60% to 70% of a purchase with debt costing 3% to 4% annually and generate positive leverage, where the rental yield exceeded the cost of borrowing. That math worked, and it drove a wave of leveraged investment into Dubai's office market. Today, borrowing rates for commercial real estate in Dubai are 7% to 9%, and banks are requiring larger down payments, often 40% to 50% of the purchase price rather than 30% to 40%. When your debt costs more than your rental yield, leverage doesn't amplify returns, it destroys them. Most investors can't make the numbers work anymore. Banks themselves have become deeply skeptical of Dubai's commercial office market. They've seen defaults, restructurings, and loan losses mount as landlords struggle to service debt on buildings that aren't generating the expected rental income. As a result, lending standards have tightened dramatically. Banks are conducting much more rigorous due diligence on buildings' cash flows, tenant quality, and occupancy rates before approving loans. Many properties simply can't qualify for financing anymore because their fundamentals are too weak. Without available financing, the pool of potential buyers shrinks to those who can pay cash, which is a tiny fraction of the market. The tenant demand picture has fundamentally shifted in ways that make investing in Dubai office space unattractive for the long term. The assumptions that drove office development in Dubai, steady growth in white-collar employment, companies needing large amounts of space, multinational corporations establishing regional headquarters, have all proven wrong or dramatically oversold. Dubai's economy is not generating the kind of job growth that requires millions of square feet of new office space. Employment in sectors that occupy offices, finance, professional services, tech, media, consulting has been flat or growing very slowly. Many companies that were supposed to bring hundreds of employees to Dubai brought dozens instead. Firms that were supposed to expand their regional operations downsized them. The wave of multinational relocations that was supposed to follow geopolitical tensions and tax changes in other countries never fully materialized. The shift to hybrid and remote work has permanently reduced demand for office space. Companies that need 50% less space than they did in 2019 are the norm, not the exception. Even when companies maintain a physical office, they're dramatically reducing square footage per employee. The old standard of 150 to 200 square feet per person has collapsed to 80 to 100 square feet in many cases, as companies adopt hot desking, flexible layouts, and reduced amenity spaces. What that means for office investors is devastating. Even if employment grows, it won't translate into proportional demand for space. The competition for tenants is so intense that landlords are cannibalizing each other on price. When a district has 40% vacancy, landlords are willing to offer almost any terms to secure a tenant. Free rent for 6 months or a year, below market rates, free parking, generous tenant improvement allowances, flexible lease terms. These concessions destroy landlord economics and make buildings less attractive to investors. Why would you buy an office building where the landlord had to offer such aggressive incentives that net effective rent is 30% to 40% below the quoted headline rate? The quality of tenants has also deteriorated. Prime office space used to be occupied by stable, credit-worthy corporations that would sign 5 or 7 year leases and reliably pay rent. Now, landlords are increasingly desperate to fill space with any tenant they can find, even if it means taking on smaller companies, startups, or firms with weaker financials. That increases credit risk and turnover risk for investors. When a building's tenant roster is full of question marks rather than blue-chip names, the investment becomes much less attractive. The broader competitive landscape has turned decisively against Dubai when it comes to attracting international real estate investment. Dubai is no longer the default choice or even a top-tier choice for investors looking to deploy capital in emerging markets. Other markets offer better returns, lower risk, more favorable fundamentals, or a combination of all three. Saudi Arabia has become the dominant destination for Gulf investment. The kingdom's Vision 2030 transformation, backed by hundreds of billions in government spending, is creating genuine economic diversification and demand for real estate across multiple sectors. Investors see Riyadh, Jeddah, and emerging cities like Neom as higher growth, higher return opportunities. The Saudi government is also offering incentives, regulatory clarity, and partnership structures that make investing there more attractive than dealing with Dubai's increasingly saturated market. Capital that would have flowed to Dubai 5 or 10 years ago is now going to Saudi projects. Abu Dhabi, Dubai's neighbor and rival, has positioned itself as the more stable, better governed alternative. The Abu Dhabi office market has lower vacancy rates, higher quality tenant bases, and better maintained properties. The government's fiscal strength and more conservative development approach mean there's less speculative excess. Investors view Abu Dhabi as lower risk, even if potential returns are also lower. In an environment where capital preservation matters as much as returns, that's a winning formula. Qatar, particularly Doha, has benefited from World Cup infrastructure investment and a more measured approach to real estate development. The office market there is smaller but healthier, with strong demand from energy sector companies and fewer speculative towers. Investors looking for Gulf exposure increasingly prefer Qatar's stability to Dubai's volatility. Beyond the Gulf, investors have shifted capital to Asian markets that offer better growth prospects. Singapore, despite high property prices, offers rule of law, liquidity, and access to broader Asian markets. Indian cities like Mumbai and Bangalore are seeing strong office demand driven by tech and services sector growth. Southeast Asian markets like Ho Chi Minh City and Bangkok offer higher yields and lower entry prices. When you stack Dubai against these alternatives, it's hard to make a bullish case. Even within real estate asset classes, investors are avoiding offices globally and rotating into other sectors. The consensus view in real estate investment is that offices are the worst performing asset class across almost all markets, facing structural challenges that won't be resolved anytime soon. Investors are preferring industrial and logistics properties, multifamily residential, data centers, even retail in some cases, over office investments. Dubai's office market is caught in a sector that's globally out of favor and a market that's locally oversupplied, the worst possible combination. The financial distress among Dubai's office property owners and developers is accelerating and starting to manifest in ways that are impossible to hide. Developers who built towers on borrowed money are facing impossible choices: continue pouring cash into money-losing buildings or default and hand the keys to the bank. Many are choosing the latter. Banks are quietly accumulating portfolios of distressed office properties through foreclosures and negotiated handovers, but they have no interest in being long-term landlords. They're trying to sell these assets, but finding buyers willing to take on troubled buildings at any price is extremely difficult. Service charge defaults are proliferating. In buildings where ownership is divided among multiple investors, collecting service charges has become a nightmare. Investors who own vacant floors stop paying their share of building operating costs because they're not generating any income. When collection rates fall below 60% or 70%, the building starts to deteriorate because there isn't enough money to properly maintain systems, pay staff, or keep common areas in good condition. That deterioration makes the building even less attractive to potential tenants, creating a death spiral. Some buildings have essentially been abandoned by their owners. The legal owner of record might still exist, but they've stopped investing any money in the property. Minimal maintenance is performed, systems are failing, and the building slowly degrades. These zombie buildings sit on the market indefinitely, too expensive to demolish, but too unprofitable to properly operate. They represent hundreds of millions of dirhams in stranded capital and losses that somebody, investors, banks, or eventually taxpayers, will have to absorb. The secondary market for office properties has essentially frozen. Very few office buildings are changing hands because buyers and sellers are so far apart on price. Sellers refuse to accept what they view as fire sale prices that would force them to recognize catastrophic losses. Buyers refuse to pay prices that don't reflect the weak cash flows and poor fundamentals. This standoff means properties that need to be sold, whether due to financial distress, fund liquidations, or estate planning, simply can't transact. That illiquidity is forcing some investors to take losses of 40%, 50%, even 60% just to exit positions, and those distressed transactions are resetting price expectations across the market. The government's options for addressing this crisis are limited and come with significant downsides. Direct bailouts of developers or investors are politically unpopular and fiscally expensive. Regulatory changes to make investing more attractive, reducing fees, streamlining processes, cutting taxes, might help at the margins but don't address the fundamental oversupply. The government has tried to stimulate demand by encouraging government entities and semi-government companies to lease space, but that's just shifting public money to subsidize private landlords without creating genuine economic activity. One option being discussed is converting office buildings to residential use. The theory is that Dubai needs housing, and converting empty offices could address both oversupply in the commercial sector and undersupply in affordable housing. But the economics are brutal. Conversion costs are high, often 40% to 60% of what it would cost to build new residential from scratch. Office buildings aren't laid out efficiently for residential use. They typically have large floor plates, insufficient natural light, and poor unit layouts. The buildings that would be easiest to convert, newer towers with better layouts, are also the ones that have the best chance of eventually attracting office tenants. The older buildings that are truly obsolete often aren't structurally suitable for residential conversion. So while conversion sounds good in theory, in practice, very few buildings are realistic candidates. Another idea is demolishing the worst-performing buildings to reduce supply. But who pays for demolition? The owners are often bankrupt or unwilling to invest more money. The banks that now own the buildings through foreclosure don't want to spend millions demolishing an asset they're trying to sell. The government could force demolitions, but that means either compensating owners or triggering a wave of litigation. And even if buildings were demolished, the land would still need to find a productive use, which brings you back to the same demand problem that created the oversupply in the first place. The ripple effects of the office investment crisis are spreading through Dubai's economy in ways that go well beyond real estate. Construction companies that specialized in office towers have seen their order books evaporate. Many have laid off workers or shut down entirely. Architecture and engineering firms that design these buildings are struggling to find new projects. Property management companies that operate office towers are losing contracts as buildings sit empty or owners cut costs. Facilities management, security, cleaning, landscaping, all of these service industries that depend on a healthy office sector are contracting. The retail and hospitality businesses that were built to serve office districts are collapsing. Restaurants, cafes, gyms, dry cleaners, convenience stores, all the support services that office workers use daily are finding that their customer base has disappeared. Areas like Business Bay, which were supposed to have thousands of office workers supporting a vibrant ground floor retail scene, instead have empty storefronts and closed businesses. That's destroying small business owners and eliminating jobs. The psychological impact is also significant. Dubai built its brand on success, growth, and opportunity. The sight of empty office towers undermines that narrative. It raises questions about the city's economic model and its long-term viability. For entrepreneurs and businesses considering Dubai as a location, the empty buildings are a warning sign that maybe the market isn't as strong as advertised. For residents, they're a reminder that the city's explosive growth era might be over. The impact on government revenues is substantial. Property-related fees and taxes, transaction charges, registration fees, service fees are a significant source of income for Dubai. When investment volumes collapse and property values fall, those revenues decline. The government has to either cut spending or find alternative revenue sources, neither of which is easy. The broader economic slowdown triggered by real estate weakness also reduces income from other sources like tourism, trade, and consumer spending. Banks face mounting pressure from the accumulation of bad loans backed by office properties. If the office market continues deteriorating and more borrowers default, some banks could face solvency issues. The government would likely step in to prevent bank failures, but that means using public resources to bail out private lenders and their shareholders. The moral hazard created by bailouts encourages more reckless lending in the future because banks know they'll be rescued if things go wrong. For the investors currently trapped in Dubai office properties, the situation is psychologically and financially devastating. Many bought at or near the peak, believing the growth story and the promises of strong returns. They're now sitting on assets worth 30% to 50% less than they paid, generating minimal or negative cash flow, and with no realistic exit strategy. Selling means accepting massive losses. Holding means continuing to bleed cash indefinitely. Some investors have just walked away, stopped making mortgage payments, and let the bank foreclose, ruining their credit, but ending the financial drain. Individual investors who bought office units as part of their retirement planning or wealth preservation strategy are in the worst position. They don't have the sophistication or resources of institutional investors. They can't afford to hold money-losing assets for years hoping for a recovery. Many are elderly or approaching retirement and were counting on rental income that never materialized. For them, the Dubai office investment has been catastrophic, wiping out savings they can't replace. The outlook for Dubai's office investment market is grim, and there's no clear path to recovery in the near to medium term. The structural issues, oversupply, weak demand, remote work, competition from other markets, are not temporary problems that will resolve themselves. They represent fundamental changes in how people work, where companies locate, and what investors want. Dubai's office market was built for a world that no longer exists, and adapting to the new reality requires a scale of adjustment that will take years, possibly decades. Vacancy rates are unlikely to improve significantly anytime soon. New supply is still coming online, demand is weak and not growing, and lease expirations mean that even currently occupied space could become vacant if tenants choose not to renew. Some analysts project that Dubai's office vacancy rate could hit 50% by 2027 if current trends continue. That would represent an almost complete market failure. Rental rates will likely continue declining as landlords compete desperately for the limited pool of tenants. Effective rents, what tenants actually pay after concessions and incentives, could fall another 20% to 30% from current levels. At that point, even well-located, high-quality buildings will struggle to generate positive cash flow. Property values will continue falling as long as income generation remains weak and investment demand stays depressed. Some forecasters believe Dubai office properties could lose another 20% to 25% in value over the next 2 to 3 years. Properties that have already fallen 30% from peak could end up down 50% or more by the time the market bottoms. The best-case scenario is a long, painful stabilization where the weakest buildings fail, supply growth stops, demand slowly recovers, and the market eventually finds equilibrium at a much lower level of activity and value. That process could take a decade or more and would still involve enormous wealth destruction for current owners and investors. The worst-case scenario is a cascading crisis where developer failures trigger bank losses, which restrict credit across the economy, which causes broader real estate price declines, which trigger more defaults in a self-reinforcing doom loop. Dubai has managed to avoid this outcome so far through forbearance, government support, and the hope that time will heal the wounds. But the longer the office crisis persists and worsens, the more fragile that hope becomes. What's most troubling about Dubai's office investment crisis is how foreseeable it was. The warning signs were there: excessive construction, weak tenant demand, shifts in work patterns, global competition. But the development continued, driven by easy money, optimism, and the belief that Dubai's growth story would overcome any obstacles. It didn't. And now, the city is left with millions of square feet of empty office space, billions of dollars in stranded capital, and a reputation among global investors as a market to avoid. Those dark towers you see from the Burj Khalifa aren't just empty buildings. They're monuments to misallocated capital, failed bets, and a development model that prioritized construction over demand. And unless something fundamental changes, they're going to stay dark for a very long time. What do you think? Would you invest in Dubai's office market today? Have you been affected by this crisis? Let me know in the comments, and subscribe for more deep dives into what's really happening in Dubai's economy.